I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be my friends. I'm just trying to make you a little money. My job is not just to entertain, but to explain. So call me at 1-800-743-CNBC. Tweet me at Jim Cramer. When interest rates go up, even if they go up just a little, you can see lots of very good, well-known stocks with juicy dividends just get pummeled. Right now, some amazing stocks of amazing companies are just getting thrown out with the proverbial bathwater. There's just one problem. Plenty of not-so-amazing stocks get hit, too, and they deserve to have their stocks go down the drain. You need to avoid those like the plague, which means it's very important to know, well, how do you tell the difference? So on a decidedly mixed day where the Dow dipped 89 points, but the S&P advanced 0.10% and the Nasdaq gained 0.72%, should you consider going against the grain to buy something that's totally out of fashion right now, but may not stay that way, particularly if we have a slowdown? Do you want to buy the stock of, let's say, a red-hot CoreWeave, a big and after hours? Or maybe buy a tried-and-true, well-known company with a very nice dividend? Oh, it's a tricky situation because we're taught to like value with income, but the stocks that have both value and income right now are getting slaughtered. While aggressive growth stocks, they're soaring. Why are the stocks of the tried-and-true companies getting crushed despite their solid dividends? Oh, there are a host of reasons. First and most important, interest rates are going higher, specifically the 10-year Treasury. It's a fierce competitor to these stocks, and the yield crossed 4.5% today. That's the magic number where investors say, ooh, I like that piece of paper. Solid yield, no risk. Get me out of stocks that yield about the same and into the bonds. Second reason why these stocks might be dangerous, government. We got a wild card Department of Health and Human Services, Bobby Kennedy Jr. We don't know whether he's for or against the companies he's regulating, probably against. And we don't know if he has the authority to do anything real negative, but he sure has the purview to look at them. So with those two caveats in mind, let's get started with the stocks that sold off hard today. Because I think it's really important because you know most, if not all, of these companies. Why don't we start with Bristol Myers, which we own for the Charitable Trust. Now, here's a drug company with a decent oncology franchise that happens to be facing what's known as a huge patent cliff, all right? It meaning it's about to have some highly lucrative drugs lose their patent protection, therefore not make them much money at all. We own it in part because of the yield. They're paying you to wait for new drugs that turn things around. The chief one is Cobenfy. It's a potentially revolutionary drug that treats some tough neurological problems, including schizophrenia. Now, we sold some of this stock when it had this ridiculous spike right here. That was some bizarre rotation into safety. But now Bristol's in the mid-40s. Now, we haven't bought back all of the stock that we sold. We're waiting for it to bottom because this most recent study is using Cobenfy. It's one study. It came up snake eyes. Management has said over and over again that it can pay the dividend, which gives you a 5.6% yield. Why not buy more? Honestly, because I think it can go lower still without evidence that Cobenfy is doing better. Or how about one of my absolute favorites right here, too, AbbVie. Now, here's a drug company with no patent cliff in sight whatsoever. It's got tremendous franchises in neurology, oncology, immunology, and medical aesthetics, among others. Because of today's vicious bond market-inspired sell-off, this fine stock's down a quick 10 points today, or more than 5%. But it only yields 3.7%. With rates going higher, you have to wonder if AbbVie's worth the risk, even as it's among the safest, if not the safest stock in the group because of these amazing franchises. I think it makes a ton of sense to start a position in the stock right now, if only because of the amazing Skyrizi and Rinvoq immunology drugs, as well as Botox, which right now is sainted for those who get too many wrinkles as their skin sags from taking GLP-1s. Those are the drugs that combat obesity and diabetes. I don't know. Tempting. Or let's consider Johnson & Johnson. AAA balance sheet. Many drugs in the pipeline. One of the best-run companies in America, if not the world, with perhaps the most billion-dollar franchises of any pharmaceutical company I know. But J&J only yields 3.55%. And it's got this terrible legal overhang related to allegations that its talcum powder, no longer on the market, caused ovarian cancer. We don't know how open-ended the claims are. Can you tolerate that risk? I'd love to say just go buy J&J, but where? What price? That yield is no longer enough to compensate you for the risk, especially if you don't know if RFK Jr. just likes some of their drug delivery mechanisms and formulas. So people are staying away from that, too, not just because of the bonds. J&J, down 3.3%. I've always believed that there are two consumer packaged goods companies that make a ton of sense whenever they go down, and that's Procter & Gamble and Colgate. Now, the former is the most unassailable consumer product lines in the world. Procter is also what we call a dividend aristocrat, increasing its payout by a little more each year for more than 70 years. Procter is such a winner. That is an amazing record. But here at $158, and again, we're focused on Procter & Gamble, less than 2 points from its low, approximately 22 points from its high. I mean, you might be thinking, how can you miss? Easy. You can miss because Procter only yields 2.68% at these levels, despite all those dividend boosts. Well, that's just not enough to compensate you for the risk. Colgate's worse. Again, 2 points off its low, more than 20 points from its high, with amazing toothpaste and pet food businesses, among so many others. But it only yields 2.37%. So why can't you buy it here? Could go lower. How does it bottom? Then let's go food. PepsiCo is, by all standards, an amazing company. Worldwide franchises in beverage and snacks. While its beverage business has a formidable competitor in Coca-Cola, their Frito-Lay snack business, well, come on, it's the best in the world. I've never seen this stock so from its high. It's at $128, down from $183. It's down to the point where it yields roughly 4.4%. But what happens if the Secretary of Health and Human Services goes after the snack business for excess salt? I don't know, because it can have excessive weight if you eat too many of them, like what else wouldn't? Or maybe he says that soda has to be a natural color, whatever color that is. Does 4.42% in yield protect you from that? Obviously, today's sellers don't think so, but this company's worth a lot more than it's selling for. I just don't know when it stops going down. General Mills, which makes top drawer pet food. Let's go over that one. Incredibly popular cereals. You know them. Trix, Lucky Charms, Fruity Cheerios. When you were a kid, was there anything more fun than eating these for breakfast? I mean, they're practically addictive for children. Even for adults. I had some last week. And that's the problem. Bobby Kennedy Jr. wants to demagnetize these cereals as well as make many other products that have artificial coloring that kids can't resist. The question becomes, what if he gets his way? Will kids eat Lucky Charms without those colorful hearts and rainbows? Can you imagine if you took the color out of Trix? It wouldn't be for kids. This stock's 1 point off its low, 22 points away from its high, yields 4.5%. 4.5%. Let's think about this. General Mills now yields the same as the 10-year Treasury. If you're nervous, if you fear Bobby Kennedy Jr., would you fear the 10-year? Nah. But you know what? You might fear General Mills. So why buy a company that could be in the government's crosshairs when you can get the equivalent yield from something that's backed by the full faith and credit of the same government that might be coming after them? I am tempted to buy General Mills, but I do fear Bobby Kennedy Jr. more than I care about how much I might make with this stock. So here's the bottom line. In a very uncertain tape for what used to be called safety stocks, I'd rather just own a piece of paper like the 10-year Treasury, where if worse comes to worse, at least I get my money back. Howard in Maryland. Howard.
Hi, Jim. How are you?
I am real good, Howard. How about you?
I'm laid up, but that's why I'm calling you. I have invested in Lockheed Martin for some months, and since some influential person knocked it and said that drones were better than the F-35, the stock hasn't performed too good. No. I'd like to know if I should buy more, hold it, or sell.
Okay, so Jim Takelet runs this company, and he's a terrific, honorable, good guy. It now yields almost 3%. You can say, well, that doesn't compensate, but it only sells for 16 times earnings. I think Lockheed Martin, you start a position right here. I would have no problem buying a stock that Jim Takelet is in charge of and that sells for only 16 times earnings. All right, this tape has turned safety stocks upside down, and I'd rather actually, at this point, unless it's really big in yield and it's safe, own the 10-year Treasury, where I can at least get my money back at the very worst. Mad Money tonight. Can cadence keep climbing alongside the market? I'm getting the read of the AI infrastructure space with the company's top brass that is ready to buy at these levels after today's monster move higher. I'm searching for answers, telling you where I stand on the stock. And could the latest headlines from Washington Post headwinds for the drug distributors? I'm going to take a closer look. So stay with Cramer.
Don't miss a second of Mad Money. Follow at Jim Cramer on X. Have a question? Tweet Cramer. Hashtag Mad Mentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.